Welcome to Finance Deep Dive. So, the Federal Reserve has this huge job, right? They steer the entire US economy, and their decisions affect literally all of us. But here's the thing. How do they know what's happening right now and not, last month? That's the billion-dollar question we're digging into.
Think about it. The Fed is making these massive calls on interest rates, moves that can hit your wallet directly. But, and this is the big catch, the official data they've always used isn't a live feed. It's kind of like trying to navigate rush hour traffic using a map that was printed last week. You're just behind.
For decades, they've relied on the gold standard stuff. The official statistics from government agencies like the Bureau of Labor Statistics. We're talking about the big ones: GDP reports, inflation numbers, the monthly jobs report. All super important.
But the real problem? The time lag. These incredibly detailed reports are amazing, but they often come out weeks or even months after the period they're measuring. So the Fed is constantly looking in the rearview mirror to decide where to go next. Now, in normal times, that delay is, it's a challenge. But during a fast-moving crisis, think about the pandemic in 2020. That delay becomes a huge liability. When the economy is changing by the day, waiting a whole month for data means you're pretty much flying blind.
So how did they fix this? Well, the Fed basically developed a whole new arsenal of what you could call hidden indicators. These are clues that give them a real-time pulse of the economy. Let's get into what they found.
The answer is something called alternative data, and it's a really simple but powerful idea. You take these massive streams of data that businesses create every single day just by operating, and you repurpose it. You give it a second life as an economic indicator.
The whole goal is to become an economic detective. By piecing together all these different kind of unconventional data points, the Fed can build a much more complete and, crucially, a much more timely picture of the economy's health. It's like putting together a giant puzzle.
So what are these digital footprints we're talking about? Well, it's the stuff we do every day. Credit and debit card transactions that show what we're spending, almost in real time. It's payroll data from companies like ADP, which can signal hiring trends weeks before the official reports. It's even online job postings and what people are typing into Google.
But hey, it's not all about clicks and code. The Fed also looks for clues in the physical world. They track the actual movement of goods and services to see what's really happening on the ground.
Okay, one of the most famous, and my personal favorite, is the Cardboard Box Index. It was a favorite of former Fed Chair Alan Greenspan. The logic is so simple it's brilliant. Companies don't order cardboard boxes for fun. They order them when they're about to make something and ship it. It's a fantastic leading indicator.
So what's it telling us right now? Well, listen to this. U.S. box makers recently pulled back their production capacity by 9%. That's the single biggest drop since the 2008 financial crisis. So yeah, that's a pretty big potential warning sign that things might be slowing down.
Another key barometer is the truck tonnage index. Now, if cardboard boxes tell you what will be shipped, trucking tells you what is being shipped right now. It's a direct measure of goods flowing through the arteries of the economy. And you really can't overstate how important this is. Trucks haul a staggering 72.7% of all freight in the entire United States. When that index moves, it means a huge chunk of the real economy is moving right along with it.
All right, here's one you might not think of. Electricity demand. But it makes perfect sense, right? Nearly every single thing we make and every service we provide needs power. So by tracking electricity use at the grid level, the Fed gets an almost perfect real-time signal of what industry and business are up to. And believe me, the search for clues gets even more creative. Analysts will actually look at things like an increase in people packing sack lunches, which is a sign of financial belt tightening. Or, a sadder one, rising pet surrender rates at shelters, which can also signal household financial stress. And even copper demand, which is a key ingredient for construction and manufacturing.
So the Fed has all these clues, digital ones, physical ones, and some that are frankly a little weird. But how do they turn this flood of messy data into a single coherent picture? Well, this is where the Economic Crime Lab gets to work, using a technique called nowcasting.
Nowcasting is actually a term they borrowed from meteorology, which is pretty cool. It's not about forecasting the future. It's about using every scrap of data available to create the most accurate picture of what's happening right now and in the very recent past. It's the science of predicting the present. And there are two main ways they do this. You can think of the New York Fed's model as a detective. It sifts through hundreds of clues, looking for a common signal, the underlying story. The Atlanta Fed's model, on the other hand, is more like a builder. It literally rebuilds the official GDP report piece by piece as new data comes in. Two totally different paths, but they're both racing toward the same goal: to understand the economy today.
So, what's the verdict? What does this whole shift towards alternative data and nowcasting really mean for how our economy is managed?
And this is the most important point. These new, super-fast tools are not a substitute for those old, reliable reports. They're a complement. Think of them as a powerful early warning system that fills in the gaps between the official numbers.
The first huge advantage is, of course, speed. Policymakers can now see the impact of a big economic shock, like a hurricane or major shutdown, in just a matter of days, not months. And that allows for much, much faster and more targeted response.
The second big advantage is granularity. So instead of just seeing this fuzzy national picture, this data lets them zoom in. They can see how specific industries or even specific cities are doing, which gives them a way more nuanced understanding of the economy. Ultimately, it's about what Fed officials call seeing the totality of the data. It's about building the most complete 360-degree view of the economy in real time. By combining the old gold standard with all these new hidden indicators, the goal is pretty simple: to make sure the Fed is never flying blind again.
If you like the content, don't forget to subscribe to Finance Deep Dive. It motivates us to keep posting.